can we take our favorite snippet, 10 seconds of the podcast, move it to the front before our intro, and then do like the proper,
E-commerce Orbit, this podcast, we're basically going to be focusing on everything e-commerce, from paid acquisition to retention marketing, specifically on the email and SMS side. We're going to be talking e-commerce finances to creative. We're going to discuss the whole process of scaling D2C brands. And obviously, you're going to be able to discover valuable insights as well from industry veterans, product specialists, and experts, as well as founders and operators in the D2C space. So our goal is to basically discover everything e-commerce, D2C related. And we'll kick it off quickly with some intros of ourselves here. So I'll hand it off to Jacob and Dylan first, introduce themselves, and then we can kind of go from there.
Yep. So I'm one of the co-founders at Aplo Group, and I oversee the email SMS side of things. So anywhere from creative, copy, strategy, implementation, fulfillment, client onboarding, and general operations here at Aplo Group.
My name's Dylan. I oversee our growth team that mainly encapsulates paid media, general e-commerce consulting, a small portion of our email and SMS team, as well as our financial modeling and our forecasting team.
Absolutely. So Liam is, well, one of the co-founders. I oversee more of the client acquisition, bringing new business on, and auditing businesses that we can help and getting them started at Aplo. So quick background on Aplo before we get into everything. So we're a D2C growth firm. We specialize in specifically the acquisition and retention channels. So mainly paid social, paid search, as well as email and SMS on the retention side. And we currently service roughly 32 clients. They range anywhere from startup to well into the 8 figures in annual revenue. And we're a team of 26, primarily based out of Canada. Most of our client base is based out of the US, but market globally as well. So with that being said, basically the first podcast today, we're just going to be focusing on kind of a look back at Q4, kind of debriefing performance, debriefing how things went. We'll talk a little bit about 2023 and our outlook on that perspective from a D2C point, and kind of go back and forth on some topics there. So I'll kick it off. Q4 was a pretty good success for Aplo on our end. We had over 90% of our client base have record Novembers. So it was great to see that. BFCM was a huge success. We'll kind of kick it off here by going through the paid acquisition side first. I'll hand it off to Dylan just to kind of run through how paid ads went, what we noticed, talk about some trends, talk about acquisition metrics and efficiency during that time, and get the ball rolling there.
Yeah, so I'd say on our end, specifically with paid media, it went very, very well. And I think some people coming into the holiday season were a little bit concerned, as there were some volatile results for some brands during the year, although we can kind of get more into the trend side of things afterwards. The biggest thing that we kind of focused on and understood and chose to kind of think hard on is that when it comes to scaling ads during the holiday period, the reality is that you have to be cognizant of the fact that a lot of these customers are not going to be your highest LTV customers. And the reason why is because whenever you're kind of thinking about like the type of customer you're buying, you're generally not only going to be buying people who are buying for themselves during this period, but you're also going to be buying for you're acquiring customers who are buying things as gifts. And because this is the case, naturally, their lifetime value is less likely to be as high because they can only gift so many times per year. Maybe they're gifting for a specific person. Maybe it's the only time they're going to gift for that specific person. So again, a lot of our clients had a lot of success, but you have to realize that a lot of these like targets you're setting, CPAs you're setting, you have to kind of look at them in a vacuum because they're not always going to have the highest LTV of all the cohorts you analyze. But overall, really, really good. A lot of clients scaled very aggressively. So happy with it across the board. I think Facebook, or I should say Meta, kind of outperformed people's expectations. Google was also did quite well. If you want to look at it this way, kind of a year of automation to some degrees in terms of campaign formats that took over with ASC campaigns on Meta, Performance Max on Google. Both of those were obviously some primary spenders. Some accounts, we've seen ASC take a little bit longer to optimize, and some accounts didn't really have the opportunity to move over to that new campaign format before BFCM. But all in all, again, Facebook kind of going the Google route to some degree with that campaign format. Google's still doing quite well. I would say if anything underperformed on average, I'd say TikTok underperformed. The thing that people have to remember about TikTok is that at the end of the day, it's great to have platform diversification. And when it comes to thinking about diversification, you obviously want to have some, but like if it's not beating your CPAs or ROAS inside of Meta or Google, it's really hard to rationalize spending money there. And we had some brands that did well on TikTok, but in terms of like actual improvements from running your BFCM offers, your holiday offers, it just didn't live up to what kind of the results that kind of got improved on both the Meta and Google side for most brands. Again, speaking in generalities here, but that's kind of what I saw with our team across the board.
Yeah, absolutely. I think a good segue to kind of touch on the email and SMS side as well on Jacob's end is kind of talking about also how we position, how we discuss and how we position the kind of lead up to Q4 with a lot of our client base and focusing heavily on being aggressive in months like September and October to acquire customers and then nurture them properly before the BFCM push, just so you could kind of create that rapport with them before the BFCM push. So I think that's probably a good segue as well into Jacob on your end with email and SMS, maybe specifically talking as well about those months leading up to BFCM, the time period leading up to BFCM, how we treated the customers that we acquired during the September and October push when we were being pretty aggressive with a lot of clients for the reason to obviously make BFCM kind of be better overall. So I think that'd be a great thing to touch on as well.
Yeah, absolutely. I think Q3 definitely has a large hand to play for many brands in terms of the outcomes for Q4, or at least definitely impacts how planning for Q4 goes on the paid side. Mm-hmm. Obviously, the paid acquisition side and the retention side are two very correlated channels, so they play into one another. So when it comes to effectively planning and setting targets, or just understanding what your risk profile is going into a weekend like Black Friday, or even just planning quarterly goals for Q4, understanding what customer acquisition looked like in Q3, and then obviously how that's driven through email, SMS from an LTV standpoint is super important. So one of the kind of identifying characteristics for a winning brand in Q4 was their ability to acquire customers in quarters leading up to Q4, and then essentially turn those customers into repeat purchasers, either through the mechanism of just a very aggressive offer in BFCM, or just through like the natural kind of foot traffic that comes with a cultural moment like holidays, gift shopping, Black Friday, Cyber Monday shopping, all that good stuff. So kind of piggybacking off of Dylan's point, again, there are a lot of new customers that you will acquire during this period of Q4 that are not necessarily going to be the highest LTV customers. So typically that cohort of customers between August and October might be your best cohort from an LTV standpoint, just because you're acquiring customers at somewhat better efficiency in Q3 potentially, and then you're able to actually realize higher LTV if they turn into repeat purchasers during this period of time. Dylan, I don't know if there's more nuance you want to add to that from a paid side, but on the email side, I would say that's like the biggest mechanism and interplay between these two channels.
Yeah, you're probably not acquiring customers with more efficiency in Q3, but it depends how you define efficiency and over what time frame. So like October is going to be, for the most part, for most brands, one of the worst months of the year. That's normally some split between October and Jan. October is kind of the one constant we find across most industries. Like, for example, like health and wellness, New Year, New You type products or offers tend to really thrive in January. Whereas most brands in general just have a harder time selling through the summer months unless they're like a summer specific SKU, albeit excluding Labor Day event, excluding Independence Day event, if you can kind of tie your brand or your offer to that. So actually what you're doing is you're acquiring customers at some of your worst CPAs and ROAS metrics for most brands in Q3. So then it's just being honest with yourself, and it's like, okay, what is my cash position? What is the different LTVs I see from these cohorts? And is that a worthwhile investment for me? And the answer for a lot of companies is yes, but you have to be in a position to be able to stomach it, because obviously you're delaying the eventual excess profits or profit targets you have on a per customer acquired basis into the future. So that kind of gets into like, how much of that am I willing to do for a better longer term, or not even longer term. 3 months is pretty short term, but longer than you're maybe used to outcome. So that's the one nuance I would say there. But the brands that did the best in Q4 are the brands that were able to, for the most part, throughout the entire year, scale pretty consistently, because you need the customer base to be able to finance that acquisition, because most brands are not profitable enough just on paid acquisition alone to be able to just scale infinitely with ad spend, because you may be hitting your acquisition targets, but you're not hitting your MER/full funnel ROAS targets. So that's kind of the only two comments I would add there.
Yeah, and I think one thing that's interesting too is like a lot of D2C brands, especially in the lead up to Q4 and lead up to BFCM and whatnot, often specifically in October, because obviously that is one of the worst months for most D2C brands, but obviously weighing the pros and the cons of being aggressive during that period of time, acquiring customers potentially at worse efficiency for the LTV that's going to obviously be provided over time, and also the value of that cohort in a month's time during BFCM. And I think that's something that from the brands that we see that do very well, and this is obviously part of our responsibility as the team that they bring on, is to basically verbalize that to them and showcase to them that, this period of time, October, for example, might look very bad on paper just from a performance standpoint overall, but being aggressive during this period of time is going to set you up a lot better to maximize November, maximize BFCM, and also maximize Q1 as well in January, when it's also slower because you have a big cohort of customers that you've recently acquired. So I think it's something across the board, like as you mentioned, Jacob, as well. The clients that we saw that did really well this year were ones that were being very aggressive leading up to this time of year. Maybe one topic as well that I think would be interesting to cover, and it's pretty relevant too, more on the paid side as well and growth side, Dylan, but is kind of the efficiency year over year for November and Q4. Obviously, a lot of brands had record months, but efficiency wise in comparison to the years prior, that might be a good discussion to kind of have here.
Yeah, I think across the board, most brands, specifically in November, saw slight improvements year over year, but and that's cool to point out and all, whether it's the aggregate e-commerce space as a whole going towards that direction. You can say it's the brand owners executing. You can say it's us, the agency, executing. Really what I think is kind of the most important thing to realize with any sort of like bigger data set or looking at averages is it's important to look at that and put some merit to kind of just get like a little like check on the industry or a check on how things are going overall. But what really matters is actually like your brand and your brand's data. So what I mean by that is like this 2022 as a whole, like we had some clients just scale like multiple hundreds of % year over year, right? We also had a few clients who like legitimately struggled. And there's a few differences here, and all of them could have looked at some average data set and came to the conclusion that like things are good, things are bad, or things are not, somewhere in the middle, neutral. Or I'll give you an example. Let's say I was a brand that had ridiculously high LTV in 2020, 2021, and I was losing money on acquisition, but I made my money back by month 6, and I still had a good amount of incremental value increase on a per customer basis after month 6. That's an investable business, and that works. What happens whenever that brand is VC backed, or that brand is operating when interest rates are like basically functionally zero? And all of a sudden, there's no more financing. Rates have like gone up like 16x or something, whatever the actual number is. And all of a sudden, that brand, which did have an investable business last year, no longer has an investable business. Or maybe at some parts of this year where CPA/CAC goes up by 20%. Well, what happens if you had no return customer revenue last year and you still don't this year, and you were 20% profitable this year, but because you were functionally just an acquisition machine or a marketing machine, now all of a sudden you don't have a business. So it kind of just comes down to like how healthy is your business actually, and what are you using to finance your growth? So let's just pretend for a second that every single brand we worked with this year had 10% worse net margins year over year. And then you look at let's say 30% last year for one brand and 10% last year for one brand. Both businesses are profitable, both are scaling, but all of a sudden though, if you take 10 basis points off of that, now you're 20 and 0. Like the brands that are the most profitable, they can afford slightly worse margins and still be able to scale like crazy. And again, this is all hypotheticals. We've had some clients improve their margins this year, some clients hold steady, and some did decline, right? But the reality is that like the comparing to like the aggregate data set is valuable, and overall I would say in November it did drop, but it is debatable how meaningful that is or how much weight you should actually assign to that.
100%. And I think it's an awesome segue too into kind of the next topic that we're going to cover here, which is more so the 2023 outlook, and just chatting about what the year ahead holds and what brands are going to succeed and what aren't. And really and truly, like I think the theme of 2023 and going into that is having a resilient business. You've already kind of alluded to it, Dylan, but if you're a business that lives and dies by acquisition metrics, and you have your acquisition costs go up 10, 20%, all of a sudden you're in an incredibly difficult situation financially as a business, obviously depending on how you're financing that growth. But more often than not, you're not going to be in a healthy spot. It's going to be much more difficult to scale. So I think obviously going into next year, resiliency, being a business that obviously can accommodate a rise in acquisition costs because you have good LTV and whatnot, and can accommodate efficiency being poor on certain acquisition channels versus others because you're diversified. Like there's a lot to kind of unpackage in terms of what's going to be important throughout 2023 and important beyond that. But I think a good starting point is just kind of talking about specifically what a resilient e-commerce business looks like, not only from an LTV standpoint, but also from basically a velocity of LTV standpoint, something we talk about a lot with clients, and obviously specifically on the email and SMS side as well, and retention channels, something that Jacob and obviously the email and SMS team focus heavily on is not only increasing LTV. LTV is great to increase, but obviously the velocity of that, which assists tremendously in terms of being aggressive on paid acquisition and making that funnel more investable overall. So I think it's a good segue into that topic. Maybe if you want to kick it off, Dylan, just in terms of maybe the acquisition side going into next year, what we're kind of looking at, what we're thinking, obviously there's a lot of things that we can't forecast. Consumer demand is one. The macroeconomic environment overall is something that's undetermined, with a high degree of accuracy yet. So there's a lot of things that are going to play out. But I think specifically on the paid side going into next year, would be great to kick it off with that and then kind of dive into the retention channels and the importance there.
Yeah, I think one big trend before getting into 2023, like if we look back at 2022 just a little bit, a lot of people were kind of like hyper focused on diversification, and I think a lot of brands probably overspent trying to diversify their paid media mix. The reality is that like for the vast majority of brands, Facebook is still by far the best. Now there's some nuances for like, I'm going to call them like commodity based products, or like they're like searchable products. Like they're not brand based product or story based products. Google is obviously still great and has gotten better. Like these two platforms have gotten better in 2022. I genuinely believe that. Some people can like get annoyed at Facebook and paid social in general for tracking, but the reality is that paid social did not lose effectiveness. If you think it did, you're probably just not looking at tracking properly. Exactly. Maybe if you compare it to like 2019, 2018, sure, let's have that conversation. But 2022 versus 2021, from what we have seen, paid social has actually gotten better, specifically on Facebook. Mm-hmm. So diversification might be a thing that occurs in 2023. Again, we're speculating on it. However, I genuinely believe that like if we're going to enter a period of time where it's harder to acquire customers, and I still think that's a pretty big if, again, it depends what you sell, how much of a necessity it is versus a luxury. I think that next year is actually ironically going to be the opposite. I think people are going to go back and basically be like, okay, we've spent all this time and money trying to diversify our paid ad spend, but this year we're just like, we need to have it be as efficient as humanly possible. Yeah. So where are we going to allocate those ad dollars? And it's probably going to actually mean taking budget away from the Snapchats, the Pinterests, the TikToks of the world, because you might think it's easier to sleep at night if you spend on like 7 platforms. But it's actually a lot harder to sleep at night if you're not profitable.
I think almost like looking back at the maybe past 12 to 18 months, like it's almost a perfect storm with all of this, because you have attribution being an issue. You have TikTok coming along as a massive new up and coming social platform with everybody flocking to it and everybody talking about how amazing it is. So you have marketers and people that, D2C brands, owners and operators and whatnot, that might not have a really good grasp on how to attribute things correctly, how to use third-party tracking, when to use third-party tracking. They see this kind of shiny object, which is TikTok. They start allocating a lot of spend there without actually understanding their metrics in the first place on the platforms that they're actually marketing on. And then you're in this kind of perpetual spiral of, allocating funds elsewhere, when in reality, you should be allocating them to the platforms that are already providing you dividends, especially in an environment where we're going into what looks like a recessionary environment, this and that. It's kind of like a perfect storm of a lot of factors there. But I guess, Jacob, on the email and SMS side, going into 2023, what's it looking like?
Yeah, I think just one thing on Dylan's point, I think it's going to be an interesting balance between, allocating your dollars where you can kind of see the most efficiency, or at least the proven kind of channels that will drive results, versus trying to build up some form of resilience and in some way hedging your bets across different platforms to kind of have that diversification of channels and channel mix. So it'll be an interesting kind of push and pull between the two to see how 2023 plays out in terms of what brands choose to do, and from a strategic standpoint, what makes the most sense. But yeah, going into 2023, I mean, we're sitting here in December. Obviously, we've just gone through a massive period of new customer acquisition. So on the email SMS side, I guess positioning new products, new offers, making sure that these customers are nurtured. On the actual macro side, from an SMS standpoint, I think there might be some changes that on the iOS side that might be impacting slightly, open rates on that standpoint. From that standpoint, in the actual SMS inbox. So that might be something to look out for.
Mhm.
On the email side, I would say that, the biggest, most material change was iOS 15 last year with open tracking.
Exactly.
But again, I would say that was largely inflating a metric that was already inaccurate to begin with. So email as a channel in terms of, its low cost ability to drive profit for brands and retain customers, drive LTV, all of those, kind of values that email brings still remain true. So I think from a macro standpoint, email is going to continue being more important for brands as an important retention channel, paired in with strategies like what is a thoughtful and consistent strategy for launching new products, testing new products, what's an offer strategy that works and that's proven. And these are different conversations for different brands based on what the goals kind of are. But I think that that's largely where email comes into play.
Yeah.
It's on the testing front with new products. It's on the offer testing front as well. That's largely where a lot of that takes place. So I would say, macro wise, from the current vantage point, email is just going to continue being more and more important. On the SMS side, we'll have to be careful in terms of how the new changes impact things. But I would say both of these own channels, prioritizing growth, prioritizing capture, making sure that these customers that are acquired are being communicated with and nurtured, making sure that new leads are being prioritized from a pop-up standpoint, optimization on site for capture, all of those things. So I'd say the rules don't really change. It's going to be just more aggressive from that standpoint going into 2023.
Absolutely. I think one good point as well to kind of dive into is definitely on the SMS side. I think a lot of brands, specifically speaking from my perspective as well, with talking to a lot of potential clients and things like that, and auditing different brands, a lot of them hesitate with the SMS channel. They hesitate to jump on it because they think it's too disruptive. They think this and that about SMS being a very aggressive medium. I think one thing that obviously it's very normalized now in the D2C space. Most brands that are operating correctly utilize it. But I think a good topic to kind of touch on, Jacob, specifically on your end, is more so SMS throughout the past maybe 12 months, the past year leading up into this year, maybe in comparison to email. Any changes that we've noticed on that channel as it's become more normalized, as more brands have started to use it? Would love to kind of dive into that, I think.
Yeah, I know it's super interesting. I think there's a few things that kind of came up into conversation. So the past 3 years, SMS has exploded as a channel in terms of both adoption by brands, but also adoption by consumers. So it's kind of like chicken and egg. What kind of led that change from a macro standpoint? Was it mass adoption on the consumer side, or was it just also mass adoption on the brand side and trying to kind of force that channel as, an additional field we're collecting and now marketing through? So there were obviously changes in compliance. There were changes in terms of how these tools were able to provide a better service, better platform for deploying SMS. And, there were regulatory changes around short codes and high throughput for, brands that were really scaling in this channel. I would say SMS, it's an interesting case in terms of how this channel is going to play out long term from a lifetime value standpoint. I think it is somewhat brand to brand dependent in terms of how much traction and reach you kind of have to your customers, or at least that relationship with the customer. Some brands are able to convert half of their email opt-ins into SMS opt-ins and see really high engagement on those channels and drive quite a bit of revenue through SMS, and even sometimes see better LTV from that SMS cohort. Is that a byproduct of the fact that maybe those customers are just going to be better anyway and they'd like to be in touch with the brand in as many ways as possible? Or is the SMS channel actually providing that better lift over a channel like email due to, like closer touch points with the customer? Maybe you can change your frequency a little bit in terms of how often you're messaging them. The, open rate argument about 100% open rates, which is not entirely true, but, you can make the case that open rates on SMS are higher than email. So it's hard to say what exactly drives that argument home. Another interesting point and part of the conversation that came up in recent months, maybe not just the past 12 months, but the past 2 years, has been this aspect of conversational, messaging and using SMS to kind of communicate with your customer on a more one-to-one basis. So using strategies like, actually having a brand representative message and reach out, to the customer to try to convert them through sort of a more human channel. So rather than blasting the customer with, for instance, this is the promo, this is the link, this is the call to action, having a dialogue with the customer. For example, Attentive Concierge. This was, an acquisition that was led by Attentive of Tone. They, ingested that tool and used the great tech that they had on that end to basically roll this into their current stack and try that sort of conversational approach with the traditional sort of send message, incite action, track conversion. So it's interesting. I think it's still up for debate how effective that approach versus just the standard, like touch point approaches from like a cost benefit standpoint. SMS is a more expensive channel than email as well. So there's another argument to be made there. At what efficiency are you actually, driving those conversions, considering that you do have a much higher cost per send than you would on email. So yeah, I think it's a really interesting conversation from just all those standpoints, because it's hard to say what actually is going to work best for all brands. But that's just like a high level kind of view at how some of the brands we've been working with have approached SMS and what findings they've seen.
Absolutely. And I think it also, like SMS, every single D2C brand can utilize it. It's just obviously a question of how extensively you can utilize it. Obviously brands that target a younger demographic or more a demographic that's more kind of in tune with SMS and utilizing that as a medium, obviously might be able to be a bit more aggressive with those types of businesses, as opposed to ones where, they're not necessarily in a demographic, but they're not necessarily selling a product that kind of lends itself to that channel as well. So it's definitely an interesting conversation to have as well with prospective clients and people kind of looking at SMS, because it really truly is something that's so easy to branch off into, and really every brand should try it, because doing it doesn't mean you have to start sending 4 or 5 texts a week whatsoever. You can start with 1 a month if you want. You know what I mean? Like, there's a lot of ways you can just kind of dip your foot in the water and test that channel out, see how your demographic responds to it, and then kind of work it into the system as you go.
Yeah, and also, I mean, on the conversational side, there's a place where specific products actually lend themselves to having more of a kind of a conversational format. For instance, like typically high AOV products that maybe have more objection up front actually do require that sort of validation from the brand, where the customer has questions about, the $2,000 couch they want to order. Maybe there is some sort of process of actually having, that product sold through a channel that is more human and more, ask questions, validate, kind of break those objections that way, rather than, for example, a simpler, lower cost, lower ticket item, which it's more just, here's the offer, here's the action, here's the urgency, and just go from there. The other thing that's interesting too is, like 3 years ago, 4 years ago, even providers like Klaviyo didn't actually offer SMS as a channel. There wasn't really a lot of saturation in space. We're seeing that change now. For better or for worse, there's definitely a lot more options now in terms of what software functionality is possible. There's much more integration capability. So you can actually integrate tools like Gorgeous and Zendesk into your stack and have this be an extension of your customer service too. So now it's a conversation not just around the marketing efforts, but how does customer service actually play into, for example, the product experience or the marketing experience, the experience with the brand itself. So it kind of leads to these bigger conversations to how is SMS as a channel not just a one-way messaging channel, but how is it also a reflection of the brand itself and the ethos of the brand, the voice, all of that sort of stuff. And also maybe even the customer experience. Maybe the product does lend itself more, interaction with the brand. And that in itself actually, has an impact on how the first few days or the experience, the life cycle of that product is viewed by the customer.
Absolutely. No, it'll be, I agree with all those points. It'll be interesting too, as we go through next year, to see how all of these different tools like Attentive, Klaviyo, et cetera, what their market share is in the SMS game, because I think it's something that's still very up and coming in the grand scheme of things compared to email, for example, as a channel that's been integral for a very long period of time. There's still a lot of brands that aren't leveraging SMS, so it'll be interesting to watch that develop. One thing too, I guess, Dylan, more on the topic you brought up earlier about diversification as well. Obviously, one thing that we're big proponents of at Aplo is diversification, not only from a platform perspective, but from a creative perspective, from an audience perspective within the respective platforms that you're marketing in, something that you talk very heavily about on the ad side as well. One thing I'm sure a lot of people are going to be wondering as we go into 2023 is, first of all, if TikTok's going to be around for the entire year. That's something that's going to be interesting. We don't know the lifespan of TikTok as a channel, but I guess maybe diving into that, obviously there's a lot of allocation of spend currently on TikTok, a lot of people leveraging it correctly. What happens if that what happens if that channel kind of, gets regulated and potentially isn't available in these markets anymore?
I think I haven't spent a tremendous amount of time looking into like the legal rules surrounding how you could actually ban an app
Yeah,
in some
exactly.
sort of country. From what I can gather, it's not that easy. And
Yeah,
once it's
I'm sure
actually
they've been
banned,
trying. I'm sure they've been trying for a little while so far already.
yeah, I think honestly, I think it depends who the next president is for who if it stays or not. But at the end of the day, that's my speculation. I think if it does get banned, it'll take a while for it to actually slowly like die off because I'm pretty sure that you can't make people remove it from their phone. So it would basically be like removing it from an app store, which gets into a whole bunch of other legal stuff. This is by no means our area of expertise. So you can kind of just take it as like you probably don't want to be 100% reliant on TikTok. That's a fair statement. I think no matter what,
Yeah.
it's a less proven platform, and that goes whether it gets banned or not. I think that there's a lot more risk there. I think there's risk being on any single platform. Like at the end of the day, whether it's 0.1% risk or however you want to actually like give it value. Um, I think again, like back to what I said earlier, when it comes to diversification, I think people just fail to realize that like you don't have to diversify. If you have something that's working really, really well, like take advantage of it. We had one client who spent on one. We had one client launch a few products in October, and one singular SKU drove over $1.5 million in revenue in like 20 days during the holiday season. One SKU, one item. That's it. like had we chosen to basically go and diversify our ad spend, we would have done less revenue, had less profit, and so on and so forth. So like it depends what time frame you view diversification. Like in a moment like that, we know that SKU is still going to be selling quite well 3 weeks from now, right? So it's like we're gonna ham like just everything into this one product. We're making so much money selling this thing versus okay, let's look at 3 years. Will this SKU, this individual product, still be competitive in the marketplace 3 years from now? So you have to kind of like place your bets. I think it's important to place your bets based off of time. But just because your friend who's also running a D2C business is scrambling to find diversification in products or ad platforms or whatever, doesn't mean you should too. It's not a. I think a lot of the people in the e-com space, especially as things have become more volatile, have kind of tried to go to this herd mentality thing. I have to try TikTok because this guy's trying TikTok or this girl's trying TikTok.
Exactly.
And don't get us wrong. We have tons of clients doing TikTok ads, doing great on TikTok. It's a great platform, but like you don't have to. And I think you really have to take a step back and be like, what are the risks facing my business? What are the risks facing the my acquisition channels? What is my spend mix? Like for example, like if I'm already on Facebook and Google are going to be around for a while still at the very least. It's like you have two platforms right there. You might have different products selling on both platforms. Like and like again, just make the decision for yourself. Don't make the decision because someone else is doing it in the industry.
And I think like with anything else too, like focus goes a long way, whether it be focusing on, a channel that is working, a product that is working, investing behind something that is actually proven rather than trying to spread yourself too thin and maybe do the moonshot. And that's not to say that you shouldn't try to do, the things on the edges that might also, produce outsized outcomes. But there's a place for testing and there's a place for focus. And if maybe survival is always the priority. And if survival is the priority, then focus on what's working is definitely the focus. But if, for example, growth is the target, then allocating where it's working and trying to scale from there is probably the most logical step forward. And then if diversification and channel mix is the priority and trying to build a more resilient kind of mix there, well then that's where testing on the edges comes in. And I guess also I'd just be curious from like both of your guys' takes. What is that fine balance of that conversation, with brands basically around healthy mix of testing new to trying what's proven and focus, right? Because there is that sort of fear of missing out aspect, Dylan, that you're mentioning. There's also the rational, I'd like to diversify slightly and have a little bit more of a resilient or protected front. So what does that kind of look like, that conversation? How does that approached from a paid side?
One thing one comment on that, and this is something that is often a question that gets asked as well from potential businesses that we're talking to, and they ask obviously like when do I know to diversify? How do I know to diversify into different platforms and different acquisition mediums? And the one thing that's important to look at, and obviously this involves you having an intimate conversation with the client, understanding their financials and whatnot, and understanding what's going on with their business, but like if you're concerned, with the upcoming year, not concerned, but there's a lot of question marks in the air. Like when it comes to diversification and kind of taking a bet on the outside, like you were saying, Jacob, like it's really a question of, okay, well, try and obviously be profitable first on acquisition or from a holistic standpoint with certain acquisition medium, and then risk your profits elsewhere to kind of mitigate the obviously downside risk that you have as a business when diversifying. Because taking that shot into the dark, while it can work and there can be massive upside from it, especially when you're in an environment like we're heading into 2023 and we're currently in, where there's a lot of question marks. It's something that really needs to be done with a lot of consideration, and risking profits is usually a better way to go than just kind of taking a shot into the dark. And I'm sure Dylan has a lot to add on to that as well, but that's just one point on mine from that perspective.
Yeah, I mean, in short, I basically agree with what Liam said. I think that it depends how much money you have and how profitable you are, and I think it depends on like how big you are. Like we have clients who spend 6 figures a day on Facebook ads. So like if you're like spending like even 5K a day, which is a pretty decent amount of money to be spending on ads per day, it's like you are a tiny drop in the bucket as it pertains to like the greater scope of what these platforms can handle. Now, again, that's not to say that like you can definitely spend 100K a day on Facebook ads, right? But it's like it depends. That's when you start getting into like total addressable market, regression in CPA/ROAS and scale, the relationship between spend and CPA/ROAS, all that good stuff. But it's like, you really don't need diversification if all things stay true. Like all the core variables or most important variables maintain over time. So like it's ultimately a personal decision because you're effectively speculating on the future potential outcomes of your current acquisition channels or retention channels for that matter too, right? Like what happens if email marketing is banned in 5 years? I don't know, right? But like probably not going to happen, but like theoretically, like what, like you can like be, doomsday planning for every potential outcome, right? But I think more frequently than not, this is a fair blanket statement. We see people try to diversify. People burn a lot more money trying to diversify than they do burning money by not diversifying. I think the best kind of like
on that point, Dylan. It's always a balance. Sorry to cut you off, but it's always a balance as well when discussing with a client. Like there's always that grass is greener on the other side mentality that a lot of people have when it comes to diversifying spend and spending on a different platform. But really and truly, like you don't necessarily know that. So just to jump in there, it's a funny balance when having that conversation.
Yeah. No, it just comes down to like brand to brand specifics. Like I think another fair blanket statement is like when we tell this to any client who's just starting out, it's like basically everyone we recommend start with Facebook ads and Google ads. It's like I'm not like there's a few clients who we've onboarded that we've spent more on Google out of the gate immediately, but that's normally because you're selling something that like just lends itself to be Google based, like things you're already looking for. But for the most part, you're going to set up your top of funnel on Meta, middle of funnel and bottom of funnel on Meta, and then you're going to have branded search, and you're going to dabble inside of shopping or PMax inside of the Google platform. Like that's kind of like the basic like campaign setup for any sort of brand that's just getting started, or any sort of not even just getting started, but like it's like just like even like just like. We audit a lot of ad accounts. We see a lot of very odd, questionable setups, quite frankly. However, at the end of the day, like whether you're just starting from square one, spending your first advertising dollar, or you've spent 50 grand overall time and performance is mediocre, but you're trying to just get like, basic best practices, so to speak. That's kind of like where we see most people start.
Yeah, I think it's interesting to your point about thresholds too, in terms of like where we start running into issues in terms of, let's say you're spending 6 figures a day. I think the surprise comes that typically it's not going to be the channel or the platform that actually serves as the bottleneck. It's actually going to be the core business economics, the cash flow planning, the inventory planning that actually end up getting in the way of being able to consistently scale at that pace and get to that point in a relatively low risk fashion. Would you agree, Dylan, that like the channel itself is not necessarily the problem? There's actually a core business element that oftentimes gets overlooked, maybe?
Yeah, the hardest thing I think is like, okay, like one of the things that people forget about cost of goods sold is that you like one of the benefits of having lower COGS as a percentage of average order value is that yes, you have more margin to work with on acquisition, but also if you have higher COGS, you actually need to be even more profitable to buy them, right? So it's like a double-edged sword where it's like, okay, if I have 25% COGS, 75% gross margins. We'll just pretend like other stuff doesn't exist, like shipping, credit card processing fees, etc. It's like, that's great. I have, fairly average D2C margins with 75%. Maybe even, I'd say actually slightly better than average. We'd have to look at like our average right now, but I think that's probably slightly better than average. And then you have a brand that's like has 50% COGS, and the brand with 50% COGS, the first thing everybody thinks of is like, okay, I have a 2 break even new customer ROAS. But also, you have to be even more profitable than the brand with better margins to go and reinvest in more inventory. So like gross margins are just so ridiculously important, and you never hear people in like in the marketing space talk about that relationship.
Yeah.
And then as it pertains to like inventory planning and all that stuff and cash flow planning, it's like yeah, if you want to do $100 million in sales at some point, like you need a lot of money, whether it's cash or cash equivalents with investor capital, debt, credit, etc. And that is very, very difficult to come up with, because obviously, especially when you're talking even just to brands that are doing like 50, 100K a month, like if you want to go and do 500K a month in sales, like you have to have the cash flows or the liquidity to be able to finance that. And exactly. that's where a lot of people actually come into problems is the cash flow planning side. 100%. And just before we go too deep down that rabbit hole, I'll just add one thing too. The biggest limitation is not the platform. It's actually where you sell and what you sell. So like every single brand has a different relationship between spend and cost per acquisition. And like we have some clients, like I said, we had one client during Q4. We started working with them on ads in October. They were spending about 5K a day. At peak, we got them over $100,000 a day. Their ROAS actually got better as we scaled, but they're selling in multiple markets, and they have a huge total addressable market, right? Like their only issue is inventory. They could have spent way more money on ads. Like they were just barely scratching the surface, I believe, of what they were spending. But a lot of brands, if you go from 5K to 100K and spend in less than a month, you will see CPA and ROAS go up. And planning for that is very difficult, and choosing to decide how you think about that. Yeah, I would say overall, it is made the biggest hurdle in scaling is not always the marketing; it's actually the finance side.
Well, it's a great point, because I think a lot of, and this is the benefit of being an agency like ourselves and having insight into dozens of brands at any given time, is because we can see obviously brands that are spending 100K per day, brands that are spending 5K per day and under and whatnot, and see the difference between that. And a lot of D2C operators, founders, owners, whatever it may be, when they're siloed within their specific singular business and they're focused on that entirely, they often don't understand, like you're saying before, Dylan, the actual what these platforms like Meta, for example, can actually withstand from a spend standpoint. And that's not saying every brand can just go in and go from 5 to 100K a day in a matter of a couple of days and see things pan out very well. But a lot of times the barrier to continue growing at a certain point really does come down to the actual financial side and understanding how aggressive you can actually be in terms of scaling while maintaining your minimum net margin to actually continue financing growth. Because that's the point, to your point, Dylan, like at a certain point, it's not necessarily marketing that is the kind of golden trick at any point. It's really just the actual finances of your business and how aggressive you can be. Go ahead.
Yeah, and it's become harder this year. Like back to what we said earlier is like, it's like if interest rate, I mean, it depends what country you're in. It depends if you're in the States, if you're in Canada. We're in Canada right now. Obviously, our rates never went quite as low as some countries. Obviously, in Europe, you had negative interest rates, but all of a sudden, if you're like, again, it depends who your lender is and how and what type of credit you're using. But like, it is way more difficult to scale with credit now than it was during COVID. Exactly. So you actually have to not only is let's say again, this is a harder year. I still don't necessarily believe that, but let's just say that's what everyone's expecting. Well, if it's a harder year and you have less access to credit, you not only have to be more profitable to just be, survive, but you actually have to be way more profitable to even just keep growing at your same growth rate.
100%.
So it's kind of, again, another double-edged sword.
100%. Go ahead, Jacob. I was just going to actually segue something to you, so go ahead.
I'm just going to say, I mean, one thing people forget, that the rate of change from 0 to 1 is actually trending to infinity. That is a change, and I'm not saying you're necessarily getting 0% financing, depends on what your terms and vehicle were and such, but that is a fundamentally very different environment to potentially start in and then to end up here 2 years later. So financing 100% and what that rate of change was will change fundamentally what the business is. And that's not just the case for e-commerce. It's broadly speaking, that's across the macro environment. So I think that, to Dylan's point, financing really does, kind of dictate how quickly things can scale or whether they can scale at all.
Exactly. And I think it's a kind of a good way to wrap up this conversation is that whole perspective of when next year, with the changes that are with the lay of the land, basically the landscape that we currently face, like resilience is everything on the D2C side. Building a business that is resilient to obviously changes in efficiency of marketing, obviously, credit being a lot more expensive than it once was. All of these factors can significantly impact your business if you're not resilient. The structure of your business is resilient to a certain degree. And that goes in again to being diversified, not only from a platform standpoint, but from a creative standpoint, audience standpoint. That goes into basically focusing on LTV as an integral piece of your business, and your return customer rate being imperative to having those metrics be strong in order to continue scaling. And again, not only LTV as one singular metric, but the velocity of LTV is going to be incredibly important to focus on as we go through 2023 as well, just to be able to obviously reinvest into scale on the acquisition side. So I think that wraps up a pretty good conversation about just kind of the performance in BFCM in Q4, kind of the macro outlook for 2023, what we're looking to see. Obviously, a lot of unknowns still, but again, moral of the story is develop your business to be resilient and really focus on the LTV side. I don't know if you guys have any other closing remarks, but I think we hit on a lot of good topics there.